Hello, and welcome to Staying Strong for Marriages. Thanks for stopping by. Hey, so this is not an advertisement. I just learned of the tax protections of something called donor advised funds. So if you pay taxes, right? And you give to charity, then this is a smarter way to do it than donating cash.
Hello. Good morning to most of you. Hope all is well. And then I need to do a rework of the Signatry, which is basically donor advised fund, which is basically like having your own mini foundation where you can put some money aside and basically we're going to look into it, but it has tax advantages. And there's also a way to, if you come into a bunch of money and you need to tithe all at once, you can stick it in one of these funds and actually be able to grow your money or your donations with 0% admin fees. That was the big game changer this week, and that's the reason for the big rework. So let's look at this donor advised fund. Like I said, first of all, 0% admin fees. I'm going to get into that because that is an important part, but if you saw last week's video, I think the bigger benefit of this is not donating cash, and let me show you why I say that. And by the way, if you did watch last week's video, this is null and void. They're not charging these fees for administrative anymore. So that's a good point to start off with before I jump into this. Okay, so this is where I think this thing really more shines, and I talked about last time, giving like stocks that you hold, say just in a normal brokerage account. The next example I'm going to look at is basically giving out of an IRA. But before I jump into this, I like this little graph that they give to us. It talks about where's most of our money. Our net worth is probably very little bit in cash, right? And it's mostly in some non-cash, some IRAs, some stocks, some bonds, maybe a business interest, maybe it's in land. Of course, for people that own, like hard assets like real estate, or you have equity in your home, then it's wrapped up in that. If you have land that you are thinking of selling, it's not liquid, and so you'd have to convert to cash, and then in order to be able to give it typically. That's not true with this, and there is a huge tax savings that we're going to look at on income taxes or capital gains taxes, and that's where I really think the beauty of this donor advised fund business is on the tax advantage, not so much on the assets growing. Although with those lower fees, maybe the assets growing as well. So that's how our net worth usually breaks down as far as our assets. But when it comes time to give, what do we usually give? We usually give out of a cash account, right? A debit account, a check, probably not as much cash, but maybe you send some money into your bank online, to your church online or something. And very rarely do we give like hard assets or stocks. Well, this kind of turns that whole thing on its head and says, hey, if you could give these non-cash items directly, there's a huge advantage to that. So let me jump into the first example that they give for us. So giving publicly traded securities like stocks, ETFs, or like bond funds. And here's just a quick example, but I think examples are like nice when it comes to finance. So the gray represents like if you sell and then you give, which is not as good as giving to the donor advised fund and letting them sell it. Okay, so here's the breakdown. It's kind of a little bit extreme example, but the idea is that you bought, say, stocks at $20,000, and the current fair market value that you could sell them for is $50,000. So they've gone up 150%, which is like a huge gain, and probably wouldn't be the case for most of us most of the time. Also, they're factoring a fairly high income tax rate at 37% and a capital gains rate of 25%. So let's look at this example because it's pretty interesting. At the end of the day, you're able to contribute $26,000 extra dollars by doing it this way, which is like, that's a load of money, right? That is a load of money, given what we're talking about here. So let's see if I can work through this example and not screw it up. So the gains that you have, you went from 20,000, you're up to 50,000, so you have $30,000 of gains. There's a capital gains tax of 25%. So 25 on $30,000 is $7,500. So if you sell that, you're going to take the capital gains hit, and instead of like cashing out for $50,000 after taxes, it drops to this lower line, which $42,500 on this. So using this little form they have, you can contribute using cash donations and like wire it or ACA it over to their bank. or you can donate securities, right? So you're donating your securities that you're up on your positions directly into your donor advised fund. So let's go back. Okay, so the whole 50,000 lands in there, not the 42,500. So you're already up 7,500 bucks by doing it this way. Okay, so the 7,500 is represented right here in this gray bar. Then on the income tax saved, it's 37% income tax rate. Okay, so then the bigger chunk of saving comes over the income tax side, and I've not really made like that much money in my life, and so I've not had capital gains to pay on securities before. But what they're basically saying is that you owe taxes, income taxes on the whole $50,000 if you do it the gray way, and $50,000 times the 37% is $18,500. So you add 18,500 plus the 7,500 here, and you get to $26,000 saved, which is like pretty phenomenal, right? Let's look at one more example. It's not as impactful. So let's look at another example. If you're already going to be taking required minimum distributions from your IRA, like a lot of like my parents are, and my parents also give like money to charity. So like, is there any savings that you can get on that end instead of converting to cash, and then when you convert to cash, owe the taxes, give directly from your IRA into one of these donor advised funds? Well, apparently there is. So here's the example. This is the income before you get any money from your IRA, right? So $140,000 of income. This is without QCD. QCD is qualified charitable distribution, which is like you distribute it into a charity, qualified charity like this. Okay, so basically on this line, you take a required minimum distribution, they have $10,000. So your adjusted gross income, if you're just doing it like a normal person, is the 140 plus the 10, takes you $150,000. Okay, then the itemized deductions are the same in both situations, $25,000 of deductions, and so taxable income is $125,000 versus $115,000. So at a income tax rate of 24%, you basically, it's 24% times the 10,000 here. This is the only one that's really different. Ends up being $2,400. Again, like kind of a lot of money. Like that could buy someone like a used car overseas or whatever. Like you could do a lot of stuff with $2,400. It's not a small amount of money just by a little bit of legwork. How much legwork does it take? I don't know. I called these people and it was kind of like annoying. Not because they were bad at customer service, but it's just I had to learn like a new process of what's ACH and how do you initiate one and how does this all work. But still, I mean, for $2,400 or for, in this case, $26,000, I think we got to say like that's probably worth the legwork. That's a lot of money. So that's what I really think is like the real big benefit of these. They have actually all kinds of fact sheets about if you want to give from your IRA, we looked at that, but if you want to, before the sale of a business, real estate interests, business interests, life insurance, bunching strategies, which is again another tax saving strategy. So like that's, I think, very interesting, and obviously I don't have time to cover all those examples, but what you get the idea that if you're a charitable person, you're going to be giving to charities, and these charities have tax breaks built within the DNA of their structure, that there's a lot of ways that I think most of us could take advantage of those tax breaks, and basically like it's just a smarter way to go about it. Let's get back to these fees, because like I said, this calling on the phone and confirming that there are 0 administrative fees, despite finding some information on an old document that they still have on their website called the user agreement. And on page 5 of the user agreement, it says that if you have under, whatever amount of money you have, you're paying some admin fee. Well, they said those days are over, and they've actually changed that, so I guess they just need to update their website. But now it's 0, so that is a huge game changer. Let me remind you of this graph that we talked about last time. It's basically the effects of fees on mutual funds. And some of the Vanguard funds you can get very low at 0.04 or 0.03 on some of their ETFs. They're like total stock market. I think ETF is VTI. I think it has a 0.03% fee. Over a 30-year investment time horizon, in this example, you're paying about 1% in fees. But as these fees that you're paying, 0.15, 0.5%, 1%, 2%, 1.5%, 2%, you keep the green and you lose the red. And so in a lot of these situations, in these examples where you're paying 2% fees annually, it ends up being that you end up losing like a third of your gains that you basically thought that you're going to have. And so the fees are very, very big. So in my thinking, it's like you want to keep those fees definitely under 1%, which we'll be able to do. But even at the 1% level, you're losing 17, almost 18% of your gains. So you'd really, really like to keep it under 1%. If you can cut it to 0.5% on fees, which is possible to do in Signatry, we're going to look at it here in a second, you're going to lose 10%. About the 0.15 management fees is pretty reasonable. You only lose like 3% of your gains over 30 years. But so these are huge, and I just want to point this out. This is true whether you use a donor advised fund or you don't. It's the difference between 8% compounded annually for 30 years versus 6%. And so it's a huge difference. I don't think most of us realize that. Since we're just talking about fees, this is basically the management fees. And you can see money markets are very low, which I really like this because on the old video I said money markets are basically undoable. Without the administrative fees, like we learned, now that admin fees have been dropped and reduced to zero, now we can do money markets. Money markets this year, in this quarter, they said, we'll look at it, made something like almost 2%, and you're paying 0.05% on money markets, which means you're able to almost have, let's just say it's just under a 2% return. Let's say it's like a 1.9% return. What that works out to be is if you have $10,000 invested in one of these, like in this fund, in money market fund, it'll basically give you back like $190 a year. Now again, $190 a year isn't like a whole heck of a lot, but for a lot of people, being able to send an extra Christmas gift in or something, $190, it's not nothing, it's not nothing. And then we'll look at some of these other situations where 0.35% on the, say, more conservative plans, 0.75 on the growth and aggressive strategies. And this one's pretty easy. It's basically the S&P 500, which is U.S. index of large capitalization companies. 500 very large United States companies is what this domestic index will give you, and it's 0.45. So like I said, you don't really want to be up nearing that 1% level here because you're losing like 20%. So some of those are 7.5, so it's going to be you're going to be losing like 15% of your gains to fees, something like that, maybe 14 or 13%. And then if you can get down to this lower level like 0.5, then it's not so bad. Well, you can do close to 0.5 with this and these, as long as you don't mess it up when you transfer your money in. So that's the other big part, and I want to show you that because that's very, very critical. Now, these are specific fees to Signatry, and honestly, there's like a whole bunch of people that do donor advised funds, like Schwab, Fidelity, like probably all of them. I just know there's a lot. I know Crew does one. But let's just look at this one for an example, so you get an idea. Remember, the high fees are the killer. So we're trying to keep these fees under, hopefully close to 0.5% in fees. Definitely we don't want to go over 1% in fees. Well, it's nice that we can do that on the management fees. It's nice that there's 0% admin fees, but there are transfer fees for transferring money, as you can see here. Basically, if you bring it in with a card, a credit card or debit card, it's going to just totally destroy the whole thing for you. 2.2% on MasterCard or Visa, 3.5% if you want to bring money in using an American Express card. Crypto has a 2% fee. So again, it's just going to destroy you. You add the 2% fee on crypto plus a management fee of say 35 basis points or 0.35%, it's almost game over. I mean, it's almost like it's just really bad once you get this concept of compounding fees. So the only real option you have is bringing your money in through an ACH or an e-check, sometimes it's called, and that's a little bit. It's not that tricky. I didn't know how to do it, so it's not establishing an external account that you can transfer money into. That's what I thought it was. That's not what it is. And if you want to do that type of thing, you basically have to use this form, follow these instructions, you fill out your information, you basically send a signed copy of this, you can electronically sign it, to Signatry, and then you have to call them and say like, hey, I do confirm, I give you like permission to withdraw like $10,000 or whatever from my checking account as stated on this form. And that's how ACHs work. So it's basically the Signatry or the donor advised fund that basically reaches out to your bank and like initiates the ACH transfer on your behalf. You have to do it that way because that's the only way you can really make it work. It's $5 max. So I still think you got to do like $5,000 or $10,000. If you pay $5 on $5,000, that's 0.1%. And if you stack that onto any of these, this would be like 0.15, with that additional 0.1 on there, it'd be 0.45, 0.45, 0.85, 0.85, 0.85, 0.55. Now, of course, you can get it lower if you transfer in like $10,000. Then it'd be even lower. But really, I mean, what you're trying to do with cash is really try to beat this. So, in some senses. Now, let's go look at some of those funds and see what their quarterly returns were. So, first of all, remember that when you're thinking about this, before we look at these like fees, one thing is that if you're like me, because these are like donations, these are ties, I don't really want to put them at risk. I'd like to play it very, very safe. And so I'm going to start with the money markets. Again, remember that this is like not going to be something, given the transfer fees, that you can just like send $200 over every month. First of all, you have to do this paperwork and sign it and email it, and it's a hassle. You can't just transfer it like you transfer money between your savings and checking account. Number two, you have to like do big chunks in order to drive those fees by percent down. So like 5,000, I would say like no less than $2,000 chunks. It's got to be 5,000 or like $10,000 would be great. I mean, $10,000 range plus. So this is going to be like a non-common type of thing. Okay, so because we now know that you can do the fees. So let's start by looking at our money market fees, which again we said were 0.05 for management fees. Plus we're going to say if we brought in $5,000 chunk, that total fees would be 0.15. Okay. So historically, the fund has made 0.89. So you subtract, let's just call it 0.9, you subtract off the 1.5 and you're at 0.75. So 0.75 on your, let's just even say $10,000 is $75. Like not really that great, right? I mean, but in this current environment, it's actually performing better than it has since inception. So like in this current quarter, the money market fund is yielding 1.9%. So like 1.9 minus the 0.15% would be 1.75%, right? So that would turn out to be $175 a year on a $10,000 donation. $175 is like kind of, it's not bad. I mean, if you're going to donate that money anyway, and I mean that could work for me. Like that could work. It's not incredible, but it's like if I have a big, like I said, a big work bonus, some lawsuit, some kind of inheritance, some kind of, I don't know when people like come into like big amounts of money, but you get the idea, right? Yeah. So So the thing that still holds true from the last time I did this first video was that if you get into any of these more aggressive funds, whether even if they're called conservative or moderately conservative, like anything over the money market funds, you're going to have market volatility. And you can see this as a great example this year where all these funds are down year to date, down 7.8%, down 11.6%, down 18.5%, down 24%, down 30%, and down 23%. So what happens really in these down markets is that I think it's a great time to be putting money into one of these things if you've been kind of like accumulating that $10,000 or $5,000 or whatever, and or if you had like a really good year at work and you knew that it was like a great time to like stick a bunch of money into an account like that, do it on a down year. Do it when you can pick these things up for 30% off or 18% discount. What it's not really good for, in my opinion, and why I think what changes about being in these, I'll just call them like risk. This is typically called risk-free. Money markets are pretty much called risk-free in the investing world, and these other strategies are risky. You can be up or down. So on these risky type of, whether low risk or high risk strategies, your money is kind of stuck, in my opinion, until it recovers. You can let it sit there, and in some of these more conservative funds, you're going to be getting coupon payments from the bonds. You're going to be getting dividend payments from the companies that have some kind of dividend payout quarterly, and so you may even get special dividends. So there's going to be like money coming into your fund just by being in these strategies. But really, I don't think, because they're investments, like I don't think you'd want to like be giving out of these things when they're down, right? Actually, the opposite would be true. You'd kind of want to, wait until they were up. That way, your donations actually grew, and maybe you could just give like extra donations from the gains. That's one way to do it. But what that ultimately means, I think, in these situations is that the market dictates the timing that your donations go out. They also kind of like very much, I mean, you can put money in any time when the market is way up or when the market's way down, of course, but if you're trying to get back to that entry level that you got in, the entry price that you got in at, if you're only going to like send money out when you're at your entry price or when the market, like the fund, is up in your favor, that could be 2 years, that could be, you don't really know. So this is kind of a different kind of animal when it comes to donations. I just want to point that out. So I think the thing that really, one of the biggest things was that with those administrative fees gone, the money market thing becomes basically like a riskless opportunity that you can take part of. And when the yields are high like they kind of are right now, and as they might hold by fourth quarter, by first quarter of 2023, you may be able to get better than 1.9%. You probably could. It should be definitely up in the twos, up in the threes. So we'll just see how long those persist. Money markets are typically defined in finance as maturity of less than 2 years. So then anything over 2 years is capital markets. So it's just a little, just to know what that means. That means these are things that have a maturity date from, I think it's from inception to maturity of 2 years. I think finally, if you do decide to go with Signatry, I just opened an account. It wasn't too bad. I don't have like a big chunk of money to send in yet, so I haven't really, just kind of like a test for all of us and for myself to kind of learn. But you can learn more about what these things mean: capital preservation pool, the conservative, the low to moderates. You can get all the information, and they give you links to the company that does this. Actually, but this isn't really so much for me. That's not why I'm doing this. It's for all of us. That for years down the road, hopefully we can be a little bit smarter, a little bit more generous just because we figured out the tax implications of these things. Like, for example, $26,000 savings, or in the IRA example, $24,000 money that you'd have available to donate to, whether that's a Great Commission or something local, Judea, Samaria, the ends of the earth. But so that's it. Thanks so much. God bless.